Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing 3D system stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. 3D Systems engineers, manufactures, and sells 3D printers, scanners, and offers a printing service. The company's chief technical officer, his name is Chuck Hull, he pioneered stereolithography and obtained a patent for the technology in 1986. The company creates 3D models, prototypes, and patterns. It uses its proprietary process to fabricate physical objects using input from computer designs and manufacturing software or 3D scanning and 3D sculpting devices. Its products are used in the design, development, and production stages of many industries, including aerospace, automotive, healthcare, dental, entertainment, and durable goods. An example of what they do is provide a dentist with a 3D model of a patient's mouth. This makes it easier to provide that patient with an implant or fit them with any dental device. The company is headquartered in Rock Hill, South Carolina, and was founded in 1986. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Zicha, Vienna, EuroTLX, Swiss, and London Stock Exchange. Let's get started with the model. This is a mid-cap company, 2.3 billion market cap. They're trading at $18 a share, and they have 128 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had their most free cash flow in the trailing 12 months at $58 million. Net income is a profit or loss on the income statement. It's revenue minus expenses. And that is negative every year except in the trailing 12 months. Revenue is a sales for the company, and that's pretty steady, from $688 million down to $637 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example of this is the cost of materials. Revenue minus cost of revenue gives you your gross profit, and that is down from $324 million to $270 million. Below that is their operating expense. Examples are R&D and marketing. Then below that is their operating income, which is negative every year. So that's not a good sign. The company has been around a long time, since 1986, and they still have negative operating income. They only spent $1.5 million of interest on their debt, which is lower than 2020 of $4 million. And the only reason they have positive net income in the trailing 12 months was this large gain of $339 million. We'll talk more about this in a little bit. But in prior years, they had negative net income. I would just focus on operating income when I look at the income statement, because the numbers in other income and expenses are one-time items that are not part of the company's core operations. This is the company's income statement from the latest quarterly report, the first 9 months of 2020 and 2021, the third quarter of 2020 and 2021. Their revenue increased from $136 million to $156 million. Their revenue is split between healthcare and industrial. It's pretty much 50% each. And their healthcare revenue went up a lot from $59 million to $76 million. Industrial had a modest increase. Their cost of revenue is $92 million, so their gross profit is $64 million. They do have good gross margins of 41%. That's gross profit over revenue. The average in their industry is 29%. The median is 31%. But their operating expenses are higher than their gross profit. They have $66 million in SG&A, $16 million in R&D. So they have an operating loss. But it's a lot better than last year. Last year they had a loss of $68 million. Now they have a loss of $17 million. But the reason it was worse last year was this goodwill impairment. When you report an impairment, you decrease the value of an asset on your balance sheet, then pass through a loss onto your income statement. In the third quarter of 2020, they had a net loss of $73 million. In the third quarter of 2021, they had a net profit of $292 million. That's mainly from this gain of $316 million in other income and expenses. Most of the gain was from the sale of Symbionix. They sold that for $305 million. What Symbionix does is it simulates surgeries, which is really helpful for medical students. And they're not in the business to buy and sell companies. That's why it's in other income and expenses. And they bought this company in 2014 for $120 million. So they did make a nice profit with the sale. This is the company's statement of cash flows, and the top line is operating cash flow. That's how much cash the company loses or generates from its operational business. So they do generate positive operating cash flow most years. It was negative in 2020. Operating cash flow is net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. And they spent $17 million in CapEx. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they did have the most free cash flow in the trailing 12 months, $58 million. They added $25 million of debt in 2018 and $25 million in 2019. They also added $25 million of stock in 2020. Since they're not generating that much cash flow, they need to fund their business with debt and equity, because they spent a lot more on CapEx in 2018 than they generated in operating cash flow. This is the company's operating cash flows directly from their 10Q. And the way you calculate operating cash flow, you start with your net income or net loss. Then you have to add or subtract the non-cash items on the income statement. We have to add back $26 million of depreciation, $44 million of stock-based compensation. And remember, we passed through that large gain on the sale of Symbionics. We have to subtract that out here because that belongs in investing cash flow, not operating cash flow. And then we have to adjust for changes in working capital. Even though they reported a net profit of $328 million, they actually only generated $63 million of cash flow, which is a lot better than last year. They had negative $32 million of cash flow. This column is the first 9 months of 2020, and this is the first 9 months of 2021. This is their revenue and operating cash flow since 2015. Their revenue is not increasing, it's flat or decreasing. And their operating cash flow is either negative or positive each year. The forecast is for their revenue to grow slightly and their operating cash flow to be flat but positive. This is the company's investing and financing sections from the statement of cash flows, the first 9 months of 2020 and the first 9 months of 2021. In their investing section, they received $430 million from the sale of some of their subsidiaries. They purchased $15 million of PP&E. They spent $11 million on acquisitions. So in their investing section, they had a cash inflow of $400 million. In their financing section, they paid down $21 million of debt. And it looks like they paid $10 million related to employee stock. So in their financing section, they had a cash outflow of $32 million. Last year was a cash outflow of $4 million. This is the equity section on their 930 balance sheet. They have $749 million of equity. They raised $1.4 billion from selling their business, and they lost $615 million from running their business. Let's look at the capital structure. $749 million of equity, $54 million of debt. They're 93% equity, 7% debt. And they could pay off all the debt with the cash on their balance sheet and still have $449 million of cash left over. This blue line is their equity balance since 2015. The red line is their debt and the green line is their cash. Their equity balance was a lot higher in 2015. It has come down, but their cash balance has come up a lot. I gave them a weighted average cost of capital of 6.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 3 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 3, that's $1.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.5 billion. We divide that by 128 million shares, and we get a calculated stock price of $12. They're trading at $18, so they're trading at a 50% premium. It's a sell according to the model. Their revenue is projected to grow 2.3%, so I grew it by that amount for the next few years. That's how I got their future revenue estimates. The average company in their industry converts 10% of their revenue into free cash flow, so I multiplied their future revenue estimates by 10%. That's how I got their future free cash flows. The website Simply Wall Street, their valuation is $528. They're saying the stock is really overvalued. 3 analysts priced this stock, and the low is 22, the high is 24. This is where the stock has been trading the last 5 years. So for a really long time, the stock went nowhere. And you could see there was a lot of buying activity in the beginning of 2021. Part of the reason is we were looking at 3D printing companies to help fix the supply chain issues. But we saw in their financials, their numbers aren't improving. They've been pretty much flatlined for the past few years. It looks like the stock broke through $50 at one point, but it's been coming down ever since. I would avoid this stock for a while. I'm pretty confident it's going to come down to single digits. They have a beta of 1.2, so the stock moves a little more than the market. It's gone down 58% in the past 52 weeks, while the S&P is up 12%. The 52-week low is 15, the high is 45. And the stock is on a major decline, trading below its 50-day and 200-day moving average. 2 million shares are traded each day on this stock. Of the 128 million shares outstanding, 125 million are on float, 69% are held by institutions, and it has a pretty high short percentage. Nearly 15% of the shares on float are shorted. Their employee count is lower than it was in 2016. They currently have 2,000 people on staff. If you invested $10,000 into this company 10 years ago, you'd be at $13,000 today. That's only a 3% annual return. In the past 12 months, there hasn't been too much insider activity. A couple of times there were buys and a couple of times there were sells. 68% of the shares are held by institutions, 29% by the general public, and 2.5% by insiders. BlackRock is the biggest shareholder at 15%, 20 million shares valued at $362 million. Then Vanguard. Cathie Wood's company Ark owns over 4% of the stock, then Invesco and State Street. Let's look at their financial ratios. The only reason they have a really good PE ratio is that large gain from the sale of Symbionics. If it wasn't for that, they would have negative net income. Their price to sales is 3.6, which is pretty good, and price to book of 3.0. Let's look at their non-current assets. 58 million of property and equipment, 30 million of intangibles, 140 million of goodwill. Goodwill is the premium you pay when you acquire another company. 45 million of right-of-use assets. This is when a company borrows an asset that's owned by another company. 3.5 million of deferred income taxes, and 21 million of other. They do have a lot of cash on their balance sheet from the sale of Symbionics. Their current ratio is above 4, that's current assets over current liabilities, and their quick ratio is 3.7. Let's look at their current assets. $500 million of cash, 90 million of accounts receivables. This is how much money other companies owe 3D. 89 million of inventory, 26 million of prepaid expenses. This means 3D made an advance payment for a product or service it's going to receive in the future. Let's look at their current liabilities. 8.2 million of right-of-use liabilities, 45 million of accounts payable. This is how much money 3D owes other companies. 78 million of accrued liabilities. These are expenses the company has incurred but hasn't paid it yet. 9.4 million of customer deposits and 28 million of deferred revenue. When a customer prepays for a product or service before they receive it, then 3D has to carry this on their balance sheet in the liability section. But when they actually send the product to the customer, then they take it off the balance sheet and book it as revenue on their income statement. They generated 58 million of free cash flow in the trailing 12 months, and they have over 500 million of working capital. So it looks like the company has enough funding to get through the next 12 months without needing any debt or equity. The best way to look at ratios is to compare them to companies in the same industry. There are 34 companies in the same industry as 3D, and 3D ranks 12th in market cap at 2.3 billion, average is 7.7 billion. And their price to book and price to earnings are a lot better than average, but their price to free cash flow and price to sales are a little worse than average. Their annual 3-year revenue growth rate is negative 2%, which isn't good. The average is 3%. To summarize, I have them trading at a 50% premium. It doesn't look like the company's really growing, but if you're confident they can get a lot of new contracts and a lot of new business, then the stock could be a good buy. But until they start increasing their revenue, getting close to $1 billion, it's really hard to see that much value in this investment. I rank their free cash flows 4 out of 10, their revenue 6 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.